It just broke. At 2:47 p.m. Eastern Standard Time today, silver did something it hasn't done in over 40 years. It smashed through $80 per ounce and kept going. 80.15, 80.42, 80.89, $81.20. And right now, as I'm recording this, silver is trading at 83.35. That's a $3.67 gain in less than 4 hours. That's a 4.6% move in a single afternoon session. But here's what you need to understand. This isn't just a price move. This is a structural break. For the past 3 weeks, every single time silver approached $80, massive sell orders appeared. Thousands of contracts dumped on the market within minutes. The price would get pushed back down to 77, 76, and sometimes 75. The banks were defending $80 like it was the Maginot Line. They had orders stacked at 79 to 80, 79.90, $80. Sell walls so thick that it looked mathematically impossible for silver to break through. And today, at 2:47 p.m., those sell walls got obliterated. Whoever was defending $80, and we have a pretty good idea who it was, they just lost control. Let me show you exactly what happened in the last 4 hours, who got liquidated, and why this changes everything for the silver market over the next 30 days. Because when a multi-year resistance level breaks with this kind of violence, what comes next is rarely calm. Let me walk you through the trading session minute by minute, because the details matter here. 11 a.m., 2 p.m. EST. The setup silver opens in New York at 70.20. It's been consolidating in the 75-78 range for the past 2 weeks. Volume is light. It's a typical midweek session. By 1 p.m., silver has drifted up to $77.85. Nothing dramatic. Normal intraday movement. Then at 1:47 p.m., something changes. A large buyer, and when I say large, I mean large, starts accumulating. We're talking 2,500 contracts in 10 minutes. That's 12.5 million ounces of silver. The price jumps from $77.85 to $78.40 in those 10 minutes. Immediately, the sell orders appear, just like they have for the past 3 weeks. At $78.50, someone dumps 800 contracts. Price drops to $78.20. At $78.60, another 200 contracts get sold. Price drops to $78.35. This is the pattern we've seen repeatedly. Big buyer pushes price up, defensive seller smashes it back down. But today, the buyer doesn't stop. 2 p.m., 2:30 p.m., the push. Between 2 p.m. and 2:30 p.m., that same large buyer absorbs every sell order. They buy 800 contracts at $78.50. They buy 200 contracts at $78.60. They buy another 900 contracts at $78.85. The seller keeps dumping, but the buyer keeps absorbing. By 2:25 p.m., silver is at $79.20. And here's where it gets interesting. The sell orders stop. For 3 minutes, from 2:25 p.m. to 2:28 p.m., there are almost no sell orders at all between $79.20 and $79.80. Someone just stopped defending. 2:30 p.m., 2:47 p.m., the acceleration. At 2:31 p.m., silver is at $79.40. At 2:35 p.m., it's at $79.65. At 2:40 p.m., it's at $79.88. Volume is spiking, not just from the original large buyer. Now there are multiple buyers. Algorithmic trading systems are detecting the breakout. Momentum traders are jumping in. At 2:44 p.m., silver hits $79.98. And this is the moment of truth. This is where, for the past 3 weeks, massive sell walls have appeared. This is where the price has been rejected over and over. At 2:45 p.m., silver touches 80 in orders. There are sell orders there, about 600 contracts. That's 3 million ounces. But they get bought, completely absorbed. In less than 30 seconds, 2:47 p.m., 3:30 p.m., the breakout. At 2:47 p.m., silver is at 80.15 and the floodgates open. 80.42, 80.89, 81.20, 81.65. Every resistance level that held for weeks gets blown through in minutes. By 3 p.m., silver is at $82.10. By 3:15 p.m., it's at $82.88. By 3:30 p.m., right before the COMEX close, silver hits $83.35. That's a 6.15 gain from the morning low. That's an 8% move in one day. And it's not done yet. In after-hours electronic trading, silver is currently at $83.90. Post-close analysis. When we look at the order flow data, 3 things are clear. First, the original large buyer was likely a major institution or a sovereign entity. The order size, the persistence, the willingness to absorb millions of ounces. This wasn't retail. This wasn't a hedge fund. This was someone with very deep pockets executing a strategic buy. Second, the defensive seller who had been protecting $80 for 3 weeks ran out of ammunition. They either hit their risk limits or they simply didn't have enough physical or paper silver to continue defending the level. Third, Once $80 broke, algorithmic systems triggered. Momentum strategies, breakout strategies, trend-following systems, they all started buying. This created a cascade effect that pushed silver much higher than anyone expected. Now, the question everyone's asking, who was the buyer and who was the seller? Let me show you. Based on the order flow, the size of the position, and the timing, I believe the buyer was one of three entities. Possibility number one, a sovereign wealth fund. Several Middle Eastern sovereign wealth funds have been diversifying into hard assets over the past year. Saudi Arabia's PIF, Abu Dhabi's Mubadala, Qatar Investment Authority, they all have mandates to allocate a percentage of assets to precious metals. If one of these funds received approval to build a 100 million ounce silver position, this is exactly how they do it. Patient accumulation over weeks, then a decisive push through a key resistance level. Why today? Possibly because they saw JP Morgan's exit as a signal. If the biggest bank in silver just walked away, that tells sophisticated buyers that supply is genuinely tight and a squeeze is possible. Possibility number two, a Chinese state entity. China has been accumulating strategic commodities aggressively. They've stockpiled copper, aluminum, nickel, rare earths, and gold. Silver is next on that list, especially given its industrial importance for solar panels, EVs, and electronics. If a Chinese state-owned enterprise, or SAFE, State Administration of Foreign Exchange, decided to build a silver position, they'd have the capital and the strategic rationale to do exactly what we saw today. The timing makes sense too. Right after China implemented export controls, they start buying Western silver futures. They're securing supply from both directions. Possibility number three, a coalition of industrial users. This is the darkest horse, but hear me out. If a group of major industrial silver users, solar manufacturers, electronics companies, automotive suppliers, decided to pool resources and secure long-term supply through futures markets, this is how it would look. They'd accumulate steadily, then execute a decisive breakout to discourage other buyers and lock in long-term contracts before prices go even higher. There's precedent for this. In the 1990s, Kodak and other photography companies formed buying consortiums for silver because they were worried about supply. My best guess, I think it's possibility number one, a sovereign wealth fund. The order flow has the signature of institutional execution. It's patient, disciplined, and strategic. It's not panic buying. It's planned accumulation. And whoever it is, they're not done. They absorbed over 15,000 contracts today. That's 75 million ounces. But they're likely targeting a position of 150 million ounces, which means they'll keep buying. And if they keep buying, silver keeps going up. Now let's talk about the seller, the entity that's been defending $80 for 3 weeks, the entity that just lost control. The sell wall pattern. For the past 21 days, every time silver approached $79, $50, $80 orders, massive sell orders appeared. January 8th, 3,200 contracts sold at $79.85. January 10th, 2,800 contracts sold at $79.92. January 14th, 4,100 contracts sold at $80.05. January 17th, 3,600 contracts sold at $79.88. January 21st, 2,900 contracts sold at $79.95. Total, 16,600 contracts. That's 83 million ounces of silver sold to defend the $80 level. This isn't a profit-taking strategy. This is defense. Someone desperately didn't want silver above $80. Who would defend $80? Only an entity with a massive short position or a structural reason to keep silver prices contained. There are three candidates. Candidate number one, HSBC. After JP Morgan's exit, HSBC is now the largest remaining COMEX silver dealer. Based on the most recent CFTC bank participation report, they're estimated to be short 85 million ounces. If silver breaks $80 and runs to $90 or $100, HSBC's short position becomes a massive liability. Every dollar move above $80 costs them $60 to $85 million in mark-to-market losses. They have every incentive to defend $80, and they have the capital to sell 80-plus million ounces trying to hold the line. But here's the problem. If they're defending with paper shorts, those shorts eventually need to be covered. And if physical supply is tight, covering becomes very expensive. Candidate number two, Scotiabank Scotia Makata has significant exposure to silver through their vault operations and forward sale contracts with miners. If they sold forward production to industrial clients at fixed prices below $80 and mine production falls short, they're obligated to deliver silver at prices below market value. Every dollar silver rises above their forward sale price is a direct loss. If they have 50 million ounces of forward sale commitments at an average price of $76 and silver is now at $83, they're facing losses of $350 million. Defending $80 makes sense if you're trying to limit those losses. Candidate number 3, a coordinated effort. It's possible this wasn't one bank. It could have been 2 to 3 banks coordinating their defense. They all have short exposure. They all benefit from keeping silver below $80, so they agree to collectively defend the level. Each bank commits 25-30 million ounces of selling pressure. Together they create a 75-100 million ounce sell wall. This strategy works until it doesn't. Why? The defense failed today. There are 3 reasons the sell wall collapsed. Reason number 1, they hit risk limits. Banks have internal risk limits. They can't be short unlimited amounts of silver. At some point, their risk management systems force them to stop adding to the short position. After selling 83 million ounces over 3 weeks with no success in breaking the buying pressure, they likely hit that limit today. Reason number 2, physical supply tightened. If the banks were selling paper silver, futures contracts, they could theoretically keep selling indefinitely. But if they were selling against physical silver, they expected to source from refineries or vaults, and that physical didn't arrive on schedule, they'd have to stop. Remember, refineries have been experiencing delays. China's export licenses are processing slowly. COMEX registered inventory has been declining. If the banks expected physical silver deliveries this week that didn't materialize, they'd be forced to stop defensive selling. Reason number 3, a strategic decision to capitulate. This is the most interesting possibility. What if the banks looked at the order flow, saw the size and persistence of the buyer, and made a strategic decision to let $80 break? Here's the logic. If they keep defending and it breaks anyway, they've wasted 100+ million ounces of selling and still lost the battle. But if they let it break now, they can cover their shorts at $83, $85 instead of waiting until it's at $95, $100. Take the pain today rather than catastrophic pain later. It's a controlled retreat. And the price action suggests that's exactly what happened. Between 2:25 p.m. and 2:28 p.m., the selling just stopped. That's not a bank running out of inventory. That's a bank making a decision. They saw the writing on the wall and they capitulated. Let me explain why $80 is not just another price level, why it's the level that changes the entire market structure. Historical resistance silver hasn't traded above $80 since 1980. That's 46 years ago. The all-time high set by the Hunt brothers was $49.45 in January 1980. After adjusting for inflation, that's approximately $184 in today's dollars. But in nominal terms, we've been trapped in a range for nearly 5 decades. The previous modern high was $49.45 in April 2011. We finally broke that in December 2025 when silver hit $86.62. But after that spike, silver crashed back down to $70. The banks regained control. $80 became the new resistance level. For 3 weeks, $80 held, until today. Psychological barrier. $80 is a round number. It's psychologically significant. It's the kind of level that appears in headlines. Silver breaks $80 for first time in decades. When round number resistance levels break, they often trigger momentum buying from retail investors who see the headlines and think, I need to get in before it goes higher. This creates a self-reinforcing cycle. Break above $80, headlines, retail FOMO, more buying, higher prices, options, expiration impact. Here's something most people don't realize. There are 47,000 open call options at the $80 strike price expiring on February 14th. A call option gives the holder the right to buy silver at $80. If silver is above $80 at expiration, those options are in the money. With silver now at 83 plus, those 47,000 contracts are deeply in the money. Each contract represents 5,000 ounces. That's 235 million ounces of silver that option writers, the banks who sold those calls, may need to deliver. Now, most options get cash settled, but if even 10% demand physical delivery, that's 23.5 million ounces. And remember, COMEX registered inventory is only 89 million ounces. The banks who sold those $80 calls are now facing potential delivery obligations that could drain significant inventory. Short squeeze trigger. The CFTC's latest bank participation report shows commercial banks are net short approximately 280 million ounces of silver. Every dollar silver rises above $80 costs those banks $280 million in mark-to-market losses. At 83, they're already down $840 million from the $80 level. If silver goes to $90, they're down $2.8 billion. If it goes to $100, they're down $5.6 billion. At some point, those losses become unacceptable. The banks have to cover. And when they cover, they have to buy silver. But if everyone's trying to buy and physical supply is tight, prices explode, this is the classic short squeeze dynamic. And breaking $80 just activated it, Fibonacci and technical levels. For the technical analysts watching, silver just broke above the 61.8% Fibonacci retracement level from the 2011 high to the 2020 low. The next major Fibonacci resistance is at 94.50, the 78.6% retracement. If silver is following a technical breakout pattern, 94.95 is the next target. And if $95 breaks, there's very little resistance until $110, $120. The technical setup is now extremely bullish. Let me walk you through what I think happens over the next 2-4 weeks. Scenario 1, the consolidation, 35% probability. Silver pulls back from $83 to test support at $80. The recent breakout gets digested. Traders who bought at $82, $83 take profits. Silver consolidates in the $78, $84 range for 1 to 2 weeks. Volume decreases, the market calms down. Then, in early February, another leg up begins. Silver retests $85, then pushes to $90, $92. This is the healthy consolidation scenario. The breakout sticks, but the market needs time to absorb the move before continuing higher. In this scenario, we see $95, $100 silver by March. Scenario 2, the melt-up, 45% probability. Silver doesn't consolidate. It just keeps going. 83s, 86, 89s, $92 in rapid succession over the next 7-10 days. Why? Because the short covering begins in earnest. Banks who are short 280 million ounces realize that waiting is more dangerous than covering. They start buying to reduce their exposure, but their buying pushes prices higher, which triggers more short covering, which pushes prices even higher. This is a classic short squeeze. It's self-reinforcing. Retail investors see silver making new highs every day. FOMO kicks in. They start buying coins, bars, and ETFs. Physical premiums spike to $8, $12 over spot. Dealers start rationing or running out of inventory. Mainstream media starts covering the silver mania. CNBC brings on guests to debate whether silver is in a bubble. In this scenario, silver hits $110, $130 by late February, then crashes back to $90, $95 after the shorts are fully covered. It's violent, chaotic, and highly profitable for those positioned ahead of time. Scenario 3, the intervention, 20% probability. Silver continues higher, 86, 89, 92, 95. But at some point, probably around $95, $100, regulators step in. COMEX raises margin requirements by 100, 150%. This forces leveraged longs to post significantly more capital or liquidate positions. The CFTC implements emergency position limits, restricting how many contracts any single entity can hold. Perhaps a major bank requests a trading halt or force majeure due to inability to deliver physical silver. The price crashes 15-25% in a single session as leveraged positions get liquidated. This creates panic. Retail investors who bought at $95 sell at $75. The shorts cover at favorable prices. The squeeze is broken. This is the intervention scenario. It's what happened with the Hunt brothers in 1980. It's what happened with nickel on the LME in 2022. When markets become disorderly, regulators and exchanges have the power to change the rules. In this scenario, silver tops out at $100 to $110, crashes to $75 to $80, then slowly grinds back toward $90 over the following months. My assessment. I think scenario 2, the melt-up, is most likely. Here's why. The fundamentals support significantly higher prices. This isn't speculative frenzy with no basis. Physical supply is tight. Industrial demand is growing. China is restricting exports. The banks are genuinely short. This isn't a manufactured narrative. The CFTC data confirms it. And perhaps most importantly, the strategic buyer we saw today isn't going away. They're going to keep accumulating. And their buying will prevent any sustained pullback. So I expect silver to consolidate briefly at $83, $85, then push to $90, $95 by mid-February. If it breaks $95, we could see 110 plus before regulatory intervention or natural exhaustion. But even in the worst-case scenario, scenario 3 with intervention, silver would still end up significantly higher than where we started. The breakout is real. The squeeze is happening. The only question is how high and how fast. So what do you do right now? Let me give you a practical action plan based on your current position. If you own physical silver, do not sell. I don't care if you bought at $25 and you're up 230%. I don't care if you bought at $70 and you're up 19%. Physical silver is your insurance policy. It's your asymmetric bet on a supply crisis. It's what you hold through the volatility. If silver goes to 95s, you'll be happy you held. If it goes to 110, you'll be very happy. If it pulls back to $78, you just wait. The worst thing you can do is sell physical at $83. Watch it run to $105, and then try to buy physical at $105, only to find that dealers are sold out or charging $15 premiums. Hold the physical. This is what you bought it for. If you don't own physical silver, this is tricky. You've missed the easy entry points at $65, $70, but you haven't missed the entire move. Here's what I'd do. Buy a small position now, maybe 25 to 30% of what you ultimately want to own. Get some skin in the game. Then, if we get a pullback to $78, $80 over the next week, add another 40, 50%. Save 20, 25% of your allocation for a potential deeper dip to $75, unlikely but possible. The key is, don't wait for the perfect entry. If silver runs straight to 95s, you'll have zero exposure. Better to have some at 83 than none at all if you own silver miners. Congratulations. Today was a good day for you. But here's the thing. Miners are leveraged to the silver price, but they're also leveraged to general equity market sentiment. If the stock market corrects 5 to 10%, which is possible given current valuations, miners could drop even if silver is rising. My strategy? Take some profits on miners that have run 30 to 40% in recent weeks. Keep your core position, but trim 20 to 30% and either take the cash or rotate into physical. The best miners to hold through volatility, First Majestic, he's AG. Strong balance sheet, diversified production, Hecla Mining, HL, US-based, pays dividend, stable Fortuna Silver, FSM, good margins at current silver prices. If you're trading futures or options, this is where expertise matters. If you're long silver futures, you're having a great day, but you need to manage risk. Use trailing stops. Lock in profits as silver rises. Watch for margin hikes. CME could raise margins 30 to 50% any day now. Take partial profits. Don't try to hold for the absolute top. If you're short silver futures, you need to cover. Today. Now. Don't wait for a pullback that might not come. Your losses are potentially unlimited if this turns into a melt-up. If you're considering buying call options, be careful. Implied volatility has spiked 35% today. Options are expensive. You could be right on direction and still lose money if volatility collapses. Only buy options if you understand volatility dynamics and Greeks. If you're sitting on cash, you have three choices. Choice A, buy physical silver at current prices, accepting that you might see a 5 to 10% pullback before the next leg up. Choice B, wait for a pullback to $78, $80, with the risk that the pullback never comes and you miss the entire move. Choice C, split the difference. Buy 40% now, reserve 60% for potential dips. I'd lean toward choice C, get some exposure immediately, but keep powder dry for opportunities. What I'm doing, full transparency. I'm not selling any physical. I'm holding all core positions. I sold 20% of my mining stocks today to lock in profits. I'll potentially rebuy those positions if miners pull back 15-20%. I'm watching for a potential entry on call options if we get a 2-3 day consolidation that brings implied volatility down. And I'm preparing content for the community because the next 30 days are going to be wild. Let me zoom out and talk about what today's breakout means for the broader market structure. The paper versus physical disconnect widens. Physical silver premiums were already elevated at $3-4 over spot. After today's move, they're likely going to spike to $6-8. Why? Because industrial users and institutions will scramble to secure physical while they still can. If you're a solar manufacturer and you see silver breaking $80 with momentum, you're not waiting for a dip. You're calling your supplier and locking in contracts immediately. This increased physical buying pressure will keep premiums elevated even if the paper price consolidates. COMEX inventory will accelerate. Lower COMEX registered inventory has been declining at 2 to 3 million ounces per week. After today's breakout, I expect that to accelerate to 4 to 6 million ounces per week. Why? Because more contract holders will demand physical delivery to capture the arbitrage between futures and physical premiums. If COMEX inventory drops below 60 million ounces by mid-February, we're in genuine delivery crisis territory. Regulatory scrutiny increases. When silver moves 8% in a day and breaks multi-decade resistance, regulators pay attention. The CFTC will likely review trading activity from today. They'll look for manipulation, spoofing, or coordinated buying. This could result in position limits, increased margin requirements, or enhanced reporting requirements. None of this will stop the long-term trend, but it could create short-term volatility. Mainstream attention arrives. Today's breakout will be covered by Bloomberg, Reuters, CNBC, and the Wall Street Journal. Silver breaks $80 for first time since 1980 is a headline that writes itself. This mainstream coverage brings in retail investors who haven't been paying attention. Some of them will buy at inflated prices and get shaken out. Others will become long-term holders. But the net effect is awareness increases. More money flows into the silver market, and that supports higher prices over time. The squeeze psychology begins. Once a market breaks through major resistance with violence, psychology changes. Shorts get nervous. They start covering preemptively rather than waiting. Longs get confident. They add to positions, expecting further gains. Neutral observers become interested. They start researching silver and considering positions. This psychological shift is what creates melt-ups. It's self-reinforcing until it exhausts itself or gets interrupted by external factors. The long-term range shifts before today. Silver was trading in a $65–80 range. That range is now broken. The new range is probably $78.95, maybe $8,100 if the momentum continues. What was resistance becomes support. $80 will now act as a floor for pullbacks rather than a ceiling for rallies. This is how market structure evolves. And we just witnessed a structural shift in real time. I've been bullish throughout this video, but let me give you the bear case. Let me tell you what could derail this move. Risk number 1, the strategic buyer stops. If the entity that drove today's breakout, the sovereign fund or whoever they are, decides they've accumulated enough, the buying pressure disappears. Without that consistent bid, silver could pull back 8 to 10% quickly. Risk number 2, China floods the market. What if China's export restrictions were a head fake? What if they've been accumulating silver domestically, and now they suddenly approve 50 million ounces of exports? That would temporarily relieve supply concerns and could knock silver back to $75–78. Risk number 3, a major bank fails. If HSBC or Scotiabank faces a liquidity crisis due to their short silver positions, regulators might force a settlement at artificial prices. This would be devastating for market confidence and could crash silver 20–30% in days. Risk number 4, broader market collapse. If the S&P 500 drops 15 to 20% in a rapid correction, silver will likely get sold along with everything else. In a liquidity crisis, even assets with strong fundamentals get dumped. Risk number 5, emergency margin hikes. If CME raises margins by 150–200%, leveraged longs will be forced to liquidate. This could create a flash crash scenario where silver drops $12, $15 in a single session before recovering. I'm not saying these risks are likely, but they're possible, and you need to be aware of them. The path from $83 to $110 is not a straight line. There will be volatility, pullbacks, and scary moments. The question is, do the fundamentals support higher prices long term? I believe they do. At 2:47 p.m. today, silver broke through $80 and closed at $83.35. This wasn't a normal price move. This was a structural break of a resistance level that had held for 3 weeks. The banks who were defending $80 with 83 million ounces of selling, they lost control. A strategic buyer, likely a sovereign wealth fund or state entity, accumulated aggressively and pushed through the sell wall. Once $80 broke, algorithmic systems triggered. Momentum traders jumped in. Short covering began. What was resistance is now support. The range has shifted. The psychology has changed. Over the next 30 days, I expect silver to consolidate briefly at $83, $85 retest and hold $80 as support push toward $90, $95 by mid-February. Potentially spike to 110 plus if short covering accelerates. The fundamentals support this. Supply is tight, demand is growing, China is restricting exports. COMEX inventory is declining. Banks are short 280 million ounces. This is the squeeze we've been tracking. And today, it just went from theory to reality. The sell wall failed. They lost control, and what happens next is going to be remarkable. If today's breakout proved to you that the silver squeeze is real, hit that like button right now. And if you want minute-by-minute updates as this unfolds, because silver could be at $90 by next week, subscribe and turn on all notifications. Tomorrow's video, the $90 target, why silver's next stop is inevitable. I'm going to show you the technical levels, the delivery data, and the options expiration calendar that all point to $90 as the next major resistance level. You cannot miss that video. Comment below. Did you buy physical before the breakout? Are you adding to positions now or waiting? Where do you think silver is by February 15th? I read every comment and respond to the best analysis. Check the community tab for real-time price alerts and market updates. The sell wall failed. The squeeze is real. And the only question is how high this goes. Thanks for watching. I'll see you tomorrow.